Scott Miner, the Global Chief Investment Officer of Guggenheim Partners. Thanks for joining us.
Scott, great to be with you.
You know, we've been seeing a lot of volatility in the markets, but you say that stocks could be higher by 20% in the next 12 to 18 months. Give us a sense of where that's coming from.
Well, history shows us that in the period that leads up to Fed tightening, that in the year that precedes the increase in rates, that we often get returns in excess of 10%, sometimes even in the neighborhood of 20%. And then layer into that in 2016, we have an election year. And election years are notoriously good for stocks. So we have a backdrop here of a lot of positive technical seasonal factors that are coming into play. And then on top of that, you have to consider the strengthening economy. As wages are growing, as employment is growing, we're going to see more domestic consumption. As we get more consumption in the economy, we should see stronger growth, and that should help propel stocks higher.
But the volatility we've been seeing in recent months, will that continue?
Well, you know, I think volatility is sort of here to stay in terms of the market trying to come to grips when the Fed's going to move. You know, the uncertainty around the timing of the Fed rate increase, I think, has caused a lot of people some concern. And then layer in on top of that the volatility of energy prices. You know, given what's gone on with oil, a lot of people thought we saw a bottom back in January. We've had the recent sell-off again. So there are enough cross currents in the market to keep volatility high for a while, I think.
All right, we're just a few weeks away from the start of first quarter earnings season, and the forecasts are looking pretty bleak, down about 4.5%. Does that worry you? I mean, don't we need to see earnings growth in order to move the markets higher?
Well, not really. Right? When you look at periods of low inflation, like the one that we're currently in, the average multiple for stocks has been almost 20 times earnings. So at the current multiple on the S&P 500, we have a fair amount of room to get some multiple expansion. I'm not surprised, given the dollar strength, to see earnings coming under pressure, and I would expect that to continue as long as the dollar keeps strengthening. But the dollar won't strengthen forever, and once we get to some sort of stability, we'll probably see earnings begin to pick up again.
All right, let's talk about the Federal Reserve. Very simply, when do you think the Fed will raise rates?
Well, the Fed, I think, will raise rates in September. I originally was of the opinion in the last couple of years we'd be at 2016, but you know, the communication from the Fed has been pretty clear. Over the weekend, James Bullard was talking about his concern with bubbles. That is that policymakers are concerned that if we keep rates too low for too long, that we might inflate another bubble. And so I think the Fed will take preemptive action so that it can't be accused later of having fallen behind the curve.
Now, the Fed will be watching employment data, inflation data in line with its dual mandate. But in the backdrop is this strengthening dollar, like you mentioned. How does the Fed grapple with this?
Well, I think the Fed is only concerned about the dollar to the extent that the strengthening dollar feeds back into the real economy. So, for instance, if we were to see a continued drag on exports, which was large enough to keep economic growth below what they think potential is, then they might slow down in their rate increase. But I don't think that the strength of the dollar will be enough in and of itself for the Fed to delay taking action in 2015.
All right, so what sectors are you watching? What are you telling clients?
Well, I mean, first off, international stocks are probably a better place to be than U.S. domestic stocks. You know, the moral of QE is that printing money raises prices. The markets in which the money printing is happening is the place where you get the best appreciation. So Europe, Japan, other parts of Asia look much more attractive than the U.S. And while I'm bullish on U.S. equities, you know, if I were going to allocate here in the United States, the two places that look most interesting to me are the banks and the energy stocks. I think it's a little too early to jump into energy given the vulnerability for more downside risk in oil. But nobody picks a bottom perfectly, and there are some pretty attractive stocks out there paying high dividends and in a 3 to 5 year horizon, which is typically what I focus on rather than quarter to quarter. I think that collecting a portfolio of high quality energy stocks will do well right now.
All right, Scott Miner, thanks for joining us.
Scott, thank you.